Hello, this is Jeb Hanwiger, editor of GoldStockTrades.com, with our market analysis on July 18, 2010. Please remember to subscribe to my free newsletter at GoldStockTrades.com for timely market updates. Bernard Baruch, famous American financier and stock speculator, said, "Never follow the crowd." Don't follow the herd. Turn CNBC off. Be aware of the obvious, as markets tend to shake out the average investor, meaning that oftentimes traders short at new lows or buy at new highs rather than looking for key support for buys or key resistance for short sales, as I'll explain on the next slide. Many times at new highs or new lows there is a shakeout, and weak traders who got into those positions at the wrong point have to cover or take a loss. One needs to be aware of mass media and major institutional research, as they tend to be contrary indicators, meaning be careful of what they say, and oftentimes it's better to go against what they're saying. As we can see with the Dow Jones Industrial Average, many subscribers were emailing me as the indexes broke into new lows recently and said, "Is that a good short point?" And I said, no, look for a point where it might come up and find resistance when the conditions are overbought. It was oversold, and we can see that there was a quick snapback after breaking into new lows here. Now, the better point is to look, as the indexes are breaking down, to look for resistance points. As you see that it failed the 50-day moving average here, it broke through the 200-day support, and then rallied up to the 50-day moving average, and then failed again. When it rallies up, and you can see a clear reversal on that day where it couldn't break the 50-day moving average, and it actually reversed that day, that was a key short point. As you can see by the volume, the price volume action is poor, and meaning that on declines you can see increases in spikes in volume, and on rally attempts the volume is low. So that's showing that institutional money, big money, is getting out of U.S. equities at the moment. So don't short into new lows. Look for key areas of resistance or a failed breakthrough of the moving average to short. So look for key areas of support to buy in an uptrend. Look for key areas of resistance to short in a downtrend. Markets don't top or bottom in one day. It's a process. It occurs over a couple of months. There are several signals to determine if a long-term trend is changing. Okay, using moving averages is one of the ways that you can identify trends and whether trends are changing. Moving averages are smoothed out price action. It makes it easier for the technician to identify the slope of the price action, the trend. The moving average in a bull market acts as key support on the way up, meaning many times it tests that moving average and successfully, and then moves on up. So it acts as a good buy point on the way up. On the way down, it acts the opposite way. It acts as resistance, and it often gives traders the opportunity to get in on the way down when it meets resistance. It's one of the most popular technical indicators because it allows the trader to ride a trend higher and prevent major losses, which is one of the trader's goals. So recently we've had a death cross in 2010. A death cross is when the 50-day moving average crosses the 200-day moving average. Both those moving averages are used by portfolio managers, banks, major institutions as medium-term and long-term trends. When used properly in conjunction with other technical tools, this crossover method says a long-term trend has changed. And oftentimes, as we saw in 2008, this death cross signals a possibility of a major market decline. So a death cross has to be confirmed. There are times that there are what's called whipsaws. But if there are additional evidence, you can confirm that a death cross is valid. Okay, one of those ways is seeing if the 200-day after the death cross occurs begins to have a negative or downward slope. When it starts sloping over, that means it's going to act as resistance. Now, in the previous chart, I showed you the head and shoulders pattern. The head and shoulders pattern completed at the same time as the crossover. So if a technical pattern completes simultaneous to a 50-day death cross crossover. That's also another confirmation of the death cross, as well as long-term trends have been broken. So one of the ways to determine time market entry, meaning not getting in when everyone's buying or everyone's selling, but trying to get in when, if you're shorting, when it's overbought, if you're going long, when it's oversold. Okay, so these oscillators are able to identify short-term market extremes, whether it's overbought or oversold. Okay, the recent market bounce with 6 straight up days on low volume gave extremely overbought readings, and it came at the same time where it was finding resistance at the 50-day moving average. The rally went too far, too fast on low volume, which signaled a dead bounce in a new bear market and another shorting opportunity. So our current outlook: the indexes now have downward sloping 50-day and a flattening 200-day moving average. Continued poor price action will take this flattening 200-day moving average and start dragging it down, which will act as a key resistance level. Poor price volume action continues to plague this market, as the rally has been on low volume, which shows a lack of support from institutional investors. And a matter of fact, this whole rally from the 2009 lows has been on low volume. The slope of the 200-day moving average turning negative will confirm the death cross, and the recent failure to break through the 200-day and continued high-volume selling signals another bearish confirmation. Okay, as we can see with the chart of the Dow Jones Industrial ETF, the rally up to the 200-day has been on very low volume and decreasing volume. And as you can look at the slow stochastic, that it had a very high, it reached almost 100 at the same time that it reached the 200-day moving average simultaneously, which indicates a possible and very highly probable reversal. So overbought conditions were signaled. It coincided with the Dow reaching a key resistance level, the 200-day moving average. Today's downward reversal from the 200-day is indicating that the counter-trend rally is completing. Traders might want to think of going short at this point, as most traders who were shorting when the index broke to new lows have covered. It's also an opportunity to move to cash if you still have long positions. Again, please, for market timely updates, subscribe to my free newsletter at goldstocktrades.com. Thank you, and have a great day.